Hey guys, in this video I want to talk about options. Specifically, I'm going to talk about a certain option play called a covered call, which is not very risky and can really boost your returns. So hey, if you're new to the channel, my name is Dan. I do a lot of investing videos on the channel, so hit that subscribe button to see more videos like this one. Alright, let's get started. So there's two kinds of options. You got calls and puts. We're just going to cover calls in this video, so don't worry about those puts for now. But with a call, you can buy a call or sell a call. If I buy a call option, I am buying the right to buy that stock for a certain price, called the strike price. Another thing I can do, of course, is sell the option to someone else. I sell you the right to buy a stock, say Tesla, for $1,000 per share. Of course, that's worthless, right? Tesla's trading for less than that. But if Tesla's stock price goes above that strike price, above 1,000, that option becomes what we call in the money. At that point, it does have value, and I, the one who sold the option, would then stand to lose some money on that. So in that example I just used there, what you did is sold what we call a naked call. That's when you don't actually own any stock of the option you're selling. When you do that, you do possibly stand to lose a lot of money. That's not a safe way to play it. That's why they call it the naked call. A better way to do it is called the covered call. And before I get into that, let's talk about the payoffs for call options generally. Okay, so first of all, here are the payoffs for owning a stock generally. As the price goes up, your profit goes up. No matter how far it goes up, that's how much your profit will be. Same if it goes down. Very simple, right? The situation is quite different when you buy a call option. Suppose you buy the option to buy a stock at $50 a share. Your payoff is going to be nothing unless the stock reaches that what we call strike price of $50 a share. At that point, every single penny it goes up beyond that is going to be your profit. So buying a call option is one way to really reduce your downside risk, but it comes at a cost here. You have to pay for that option. Now there's always someone on the other side of the trade, right? So someone has to sell a call for $50 a share. If they do that, they immediately gain a profit from selling that option, and that profit is the same no matter what happens to the share price, unless of course the share price hits that S again for a strike price. And at that point, they're in trouble. The further the price goes up beyond that, the more money they lose. So what we do with a covered call is we combine owning the stock with selling a call option. So again, you own the stock and you sell a call option on that stock. When you do that, your payoff looks like this. Yes, if the stock goes down, you still bear the risk of that. You're still going to have losses there. But you're essentially capping your gains. You can make money when the stock price goes up, but if it hits that strike price, at that point you won't make any more money. Your profits will flatten off there because you're going to have the person who bought that call is going to exercise it. They're going to buy your shares from you. Now, why is this better than simply owning a stock? Well, it's not necessarily. It depends on your risk preferences, depends on what you think about the stock market at that point in time, but it can be a very useful strategy. For example, one thing that I'm doing in my portfolio is that I own shares of Altria Group, ticker symbol MO. Now this stock pretty much trades around the same range. I've never seen it really hit $50 a share in the past year. So what I've done here is, in addition to receiving my roughly 8% dividend every year, in addition to that, I am selling call options on this stock. And by doing so, I can generate an additional roughly 2% return per year. The only drawback to this is if the stock ever goes up to $50, which happens to be the strike price that I sold at, I will have to give up my shares. But for me, I'm not worried about that. With the stock currently priced at about $40, if it went up to $50, at that point that would be a 20% gain for me. I'd be very comfortable with that. I really wouldn't mind to get rid of it at that point. So it's a nice way to boost your return on some of your safer investments that don't have a lot of volatility. So that's the idea with covered calls, guys. Again, you buy the stock, you sell the call. you get a little extra money. Unfortunately, you limit your upside, but it's an option that you may want to consider. Thank you guys for watching. I really appreciate it. Let me know what you think in the comments below.